Many traders try to use ICT strategies in the crypto market, but soon enough, they are faced with reality. Everything works differently here. Algorithms behave differently, manipulations occur at different times, and familiar models simply do not work as well as they do in Forex or indices. I decided to figure out why this is happening and what really works. In this video, you will learn not only how to find profitable trades on crypto, but also which assets to pay attention to first. To begin with, it's important to understand the key difference between the crypto market and traditional markets, such as Forex or stocks. In the stock market, prices are driven by institutional investors, large banks, funds, and hedge funds. These are centralized players with billions under management and clear rules of conduct. Forex is basically an interbank liquidity market where algorithms of a different nature operate. The crypto market, on the other hand, is a completely different ecosystem. First, each token can have its own separate market maker, not a large bank, but a project team, private fund, or algorithmic protocol that simply serves its own coin. This is why the logic of manipulation is different. Movements are more aggressive, local, and very often tied not to global reports, but to the internal mechanics of the asset itself. Second, crypto trades 24/7. There are no breaks on weekends, no clearly fixed sessions, but that doesn't mean the time doesn't matter. On the contrary, even in such a continuous schedule, behavioral scenarios are clearly visible, especially around London and New York. It's just that these patterns are different from what you're used to seeing in Forex. Exactly these features make traditional ICT patterns not applicable in their original form, but if you adapt to crypto, you can find surprisingly accurate and recurring entry points. I'll show you how this works with specific examples. When I started testing different tokens on the crypto market, I realized one thing. Simply taking ICT strategies from Forex or the stock market and applying them here doesn't work, at least not in the way you would expect. But the deeper I analyzed the charts, the clearer it became. Some tokens show clear, repetitive manipulation. And the most interesting thing is that each asset has its own pattern. It feels like different teams of market makers are working on different tokens, and each has its own scenario. One such asset is the pump token. I looked through dozens of trading days, tracked price behavior in different sessions, ran scenarios through backtests, and compared them with real trading. As a result, I found a repeatable pattern that works almost every day. Now I'll show you how it works. First, for the setup to work, you need a trend, a clear directional movement, either upwards or downward. Let's take the current situation. The market is in an uptrend. Now here's the key. If between 4 o'clock and 5:30 a.m. New York time, liquidity is withdrawn from Asian lows, this almost always triggers a continuation of the trend. If the trend is downward, the logic is the same, only the manipulation must be from Asian highs in the same time window. What is particularly interesting is that previously, manipulation of this token took place during the New York session, but now it has clearly shifted to London. Apparently, the market-making structure has changed, and now all the active work begins in the morning. After I see manipulation, I wait for the structure to change. As soon as it appears and stabilizes, I enter. There is no need to wait for pullbacks. This is not that kind of asset. Here, there is almost never a nice retest, as is often the case in classic ICT scenarios. I set a stop behind the candle where the manipulation occurred. Take profit, first at the Asian high. If it's close, I move it higher, to the high of the previous day's New York session. In practice, this is one of the simplest and most straightforward setups I have ever traded on the crypto market. The next asset on my list is Cardano, and with it, things get even more interesting. If manipulation on the pump token occurs during the London session, then with Cardano, it almost always starts in New York, and it repeats with such regularity that once you see it once, you will begin to notice a similar scenario literally every day. Almost every day between 8:30 and 11:30 New York time, the market withdraws liquidity from the lows of the London session. This withdrawal is only relevant in an uptrend. In a downtrend, we look for liquidity withdrawal from the highs. This is the main trigger for our trade. As soon as I see such manipulation in this time window, I immediately move on to the next step, changing the structure. After that, I enter the trade without waiting for a pullback. This is a general principle that I have already explained using the example of pump. Here too, there is no point in waiting for a retest. ADA moves quickly. If you miss the moment, you can forget about a good entry price. The stop should be set for manipulation. Take profit at the maximum of the Asian session. In my opinion, Cardano is one of the cleanest assets for trading on manipulation. It's not as volatile as meme tokens, doesn't take out stops out of nowhere, and at the same time works well if you understand what you're looking for. It is during this time interval, from 8:30 to 11:30, that liquidity is being withdrawn almost every day, followed by the real movement, that makes sense to trade. Many people think that such scenarios are rare, but in fact there may be many more tokens with repeatable manipulations. They just don't lie on the surface. To find these two, Pump and Cardano, I went through dozens of assets, tracked their behavior in different sessions, ran ideas through backtests, and tested them in practice. It took a lot of time, but the result is worth it. I now have clear models that consistently generate profits through repeatable movement logic. And if you don't want to spend weeks on testing, but just want to trade and earn money, there is a tool that makes everything easier. It's called the OWL indicator. Important, OWL is not related to liquidity or smart money. It's a trend-based system with strict risk management and clear rules. No guesswork. The indicator itself determines the entry point, stop, and take profits strictly according to its logic. I recently had a trade on ETH based on an OWL signal. It brought in about $11,000. And to simplify the process even more, after purchase, I'll send you OWL Helper, an expert advisor that automatically calculates stops and takes, helps you place trades correctly, and saves time. To get it, message me on Telegram. Hi, send me the OWL Helper Expert Advisor. I bought the indicator and the date of purchase. The link to the indicator itself is in the description below the video. And now for those who want to learn how to find such scenarios themselves. I started with backtests. I opened charts, watched how the token behaved in different sessions, and recorded moments where manipulation occurred, especially liquidity withdrawal in a clear time window. If the pattern repeated itself, I started tracking the asset in real time, looking for confirmation, structure, and price reaction. Step by step, I came up with the tokens I showed you today. If you find another asset with a repeating pattern, write about it in the comments. I'll definitely look at it, check it out, and possibly include it in the next video. I trade crypto through the Evedex exchange. It's a decentralized platform with a user-friendly interface, fast trade execution, and minimal commissions. No verifications, no restrictions, just connect your wallet and start trading. What's especially important is that the tokens we discussed in this video are traded on this platform. Pump, ADA, and other altcoins on which repeatable scenarios really work. If you trade based on structure, taking into account manipulations and price movement logic, Evedex provides everything you need. The link to the exchange is in the description. If you've tried to apply ICT to crypto, you already know that everything works differently in this case. Time windows, manipulations, movement after liquidity withdrawal, all of this is subject to different algorithms. But that's where the opportunity lies. Each token can have its own unique scenario, its own behavior model, and if you find it, all you have to do is repeat it. As I said at the beginning, such manipulations most likely occur because many tokens have their own teams of market makers. They move the price according to set algorithms, and this is what creates repeatability. These patterns may change over time, but the very fact that they exist opens up enormous opportunities for those who know how to observe and adapt. I hope this video has helped you better understand how to trade crypto based on real market mechanisms rather than guesswork. If you found it useful, please support the video. See you in the next videos.